guest in our studio, Pallavi Malani, Managing Director and Partner at Boston Consulting Group and India Leader Insurance. Thank you so much, Pallavi, for joining Insurance Mantra.
Thank you, Anurag. Thank you for having me again.
Ma'am, I just want to start with, if we go by the FY26 numbers, recently BCG has also released a report in which we have seen that growth in non-life segment, general insurance also, which is led by motor and health insurance. And in life insurance, we have seen the growth across the segment. So that data is suggesting that we are deepening insurance market in India, or this growth is just due to motor and health only?
Great question, Anurag. The growth is definitely there. We are growing. The life insurance segment has grown at about 14%. Individual business has grown at about 10%. And on the general insurance side, the industry has grown at about 10%. The real question is, where is this growth coming from? So in the life insurance sector, the growth is concentrated in the top 50 cities. The top 50 cities, the 8 metros and 42 tier 1 cities, contribute to 89% of the total premium on the life insurance side.
Okay, so out of 700 pin codes, only 50 pin codes are contributing?
50 cities, 50 which will be a lot more pin codes,
which will be around
but 50 cities only. In addition to that, the other data point that's very interesting is that more than 50% of this business is concentrated in families with annual income of more than 10 lakhs.
Okay.
So while in NOP terms, even families less than 10 lakhs have 69% of their share, but in value terms, the bulk of the value is coming from families which are more than 10 lakhs of income. So the growth honestly is not very broad-based. The last point is that while there is a 10 to 14% growth, whether you look at the total or the individual premium, the NOPs have only grown by 5%. Large part of the growth is driven by the ticket size, which means people who are buying larger, possibly buying with the right riders also attached to it, which is great, but we need more people to buy the policies, and that broad basing is not happening.
So data is suggesting that number of policies are not increasing.
Yes, right.
And
even on the general insurance side, while the growth has been 10%, largely driven by health, which is again great because there's awareness. The GST move has clearly played out, so more people are aware and buying health. But some of the other subsegments are not seeing the kind of growth.
Medical inflation is also contributing in that because
the prices have gone up.
So, with your data also suggests it's a useful data for insurers that a lot of scope beyond that 50 cities, they can reach out there, they can change their distribution model, and because apart from that 50 cities, public is there who want to buy insurance.
Absolutely, the public is there who want to buy insurance. The question is the cost of reach to those cities, and can we create distribution models which can ensure that we can reach those more remote areas in a more cost-effective way and drive the penetration, which in my view, Anurag, will need some business model innovation, because the way the industry has come along, it's been very agency-led, right? And agency comes with a very heavy cost structure because you need the whole frontline sales and the hierarchy to manage the large base of advisors. How do we use technology to drive efficiency, productivity of the advisors without having to deploy that kind of human machinery to manage? And that will create the effect for us to reach more of the hinterlands.
Next phase of distribution will be led by agency model in rural areas through bank branches, or the tech also, because a lot of companies are adopting tech, and now regulator is all set to come with the Bima Sugam also. So next phase will be driven by which model?
It will be a combination of all models, because there will be no one-size-fits-all for India. But I believe it will be human-led. We will still have humans giving the advice. However, technology needs to remove the friction and reduce the cost of that advice. Insurance will continue to be, again, more human-led, more, informed decision. Is still going to come. Yeah, the nudge is always required. But technology can definitely reduce the friction in terms of the paperwork, the processing cost.
Technology can make it affordable also?
Technology can, why is insurance
Means the
not?
distribution cost.
Absolutely, absolutely. The problem with affordability, Anurag, is we have to think of it in three parts. One is the cost of risk. That's exactly what we are paying for, right? That if I have a problem, the insurer will take care of me. The cost of risk needs to come down. For every 100 rupees of health insurance premium that we pay, about 80 odd rupees just goes in paying claims, right? So how do we use technology to reduce the cost of risk? That's one part. That will bring affordability. The second is cost of reach, which is where the distribution reforms. Technology can play a role in reducing the cost that we incur in providing that distribution, and then the commission reforms, etc., can bring in more transparency and affordability for the customers. And then there is the cost of friction, which is going back and asking for paperwork. You know, what things that are not needed, we again ask for documentation. Things which needs to be done manually. We can reduce all of that and reduce the cost of friction. So if we reduce the cost of risk, the cost of reach, and the cost of friction, we can bring in affordability into the sector.
Okay. And with the help of technology, that trust can also improve, because of one big challenge in insurance, which a regulator is also mentioning again and again, that insurers should work on trust among customer, trust among policyholders.
Anurag, let me answer this slightly differently. We did a very interesting research. It's also part of the report. We actually analyzed about 2.5 lakh mentions that consumers put on any digital platform in the last 3 years. We did that 2.5 lakh analysis for general insurance, and we analyzed again
all the
about
grievances.
It can be any review that a customer has put on any social media channel. It can be a comment, a review, a complaint, a grievance. It can be anything that they put online.
So online, most of that I have come across negatives only.
I will prove you wrong right now, because in the life insurance sector, of the 2.5 lakh mentions in the last 3 years related to anything about life insurance, about only 1/3 is negative.
Okay.
2/3 is actually positive, where there are a lot of positive stories that people put out there of how insurance has helped them, or how at the time of need.
These kind of stories never got amplified.
Exactly. Of the 1/3 which are negative, about 44% is linked to claims.
Okay.
People are happy that there is digitization, paying renewal premiums is easier, buying a policy is easier, paperwork is lesser. People are appreciative of that. That's what our research shows. But at the moment of truth, two things which stand out. One, at the time of claims, people are still, you know, putting in a lot of negative mentions. And then there are some grievances related to servicing. All of it boils down to, in my view, three things. People want no surprises.
No surprises. Everything should be mentioned.
People want no surprises. So tell us what you want upfront, or do the underwriting properly. Don't tell me later your claim can't be paid. So people don't want surprises. The second is people don't want jargons. Explain it to me simply when I'm buying the policy so that I don't realize it later. And people don't want repeat. Whatever you need from me, come once, ask me for it. Don't come at the time of claim again and again to my nominee or, you know, whoever's the caregiver to ask for documentation. So no surprises, no jargon, no repeat.
Okay.
That's what the synthesis of what consumers are saying.
So out of 2.5 lakh, around 1.5 lakh reviews were positive. Only 1 lakh reviews were negative, which you have analyzed. So what is there any time frame of this?
From 2023, we've analyzed over 3 years.
Okay.
So we've looked at it both on the life insurance side and the general insurance side.
And the negative reviews you have got, which were the most complaints you have collected?
Largely on the general insurance side, linked to claims and claims experience. In that, the moment of truth, why are claims getting rejected, and couldn't I have known this earlier?
Okay.
And that again goes back to saying that if we do the underwriting properly and we do the customer education at the time of sale. And then not at the time of...
The role of distributor also comes in.
Yes, yes. Large part of the complaints are linked to claims and claims rejections. And then some are linked to customer
very positive
servicing.
study for insurers, because they are always worried about that perception about industry is negative only. On social media, most of the comments are negative only, but your study shows that...
what gets amplified is a lot of the negativity. And, through your platform where you're doing great work, we need to bring out these positive stories.
Okay. But rising cost is also a concern among the customers or policy holders. Affordability, I mean to say that.
See, there is no denying the fact that because of medical inflation, the costs are rising. Because of other OPEX, which is increasing for insurers, like even if you see this year, the OPEX has increased by about 18%, on the life insurance side. So because of rising OPEX, the cost for policies are becoming more expensive. And there is a need for us to solve the...
employee cost also increased by 10%.
That's right.
And on IT also, the expenditure has increased. The cost on IT for the overall industry has increased?
Yes, 14%.
14%.
Yes. So technology costs have risen. Employee costs have also risen. And, a lot of people ask us, that's quite a paradox or that's quite a dichotomy, because if technology cost is rising, technically we shouldn't be spending more, on employees. Actually, I would say, think of it like, building a new house. When you're building a new house, you're still living in your old house and maintaining it and running it while you're building the new house. So this is the investment phase for insurance.
So 2 years down the line, 5 years down the line, ratios will change. This data, which is 14% and 10%, will be reversed.
I hope so. I think that should be the trend, because with more technology adoption, we should be able to manage at much lower costs. All of that should then translate into, being able to drive growth without necessarily having to increase manpower. But as of now, insurers are running both the models. They are running the core business.
Yes,
so you have to invest in running the core technology.
And the future model also.
Yes, while building the highway for AI, cyber, other, talent pools which are needed, regulatory changes which are coming. You have to continue to invest in those as well. So I think right now it's that investment phase.
If we talk about the general insurance industry, underwriting losses are there. So how big is this concern? And going ahead, do you think that the margins will be thin only for insurers as of now for next few years?
Underwriting losses are real. The industry incurred about 30,000 crores of underwriting losses in FY26, right? And then we made about 36,000 crores in investment income. So if you break it, actually, Anurag, industry grew at 10%. At industry level, we delivered 6% ROE. If I look at it on the health insurance side, it grew at 21%. The ROE is 1%. If we look at the small or emerging insurers, the growth is 34%. The ROE is negative -3, -4%.
For most of the insurers.
For emerging, for the young, for the newer insurers. But for the older, the large insurers, which is the large and the mid-sized insurers, the industry has grown, they have grown at about 7% while delivering an ROE of 15%. So when we say that companies are not making money or not being able to deliver ROEs, we need to de-average it and see it, because there are large insurers who have been able to grow moderately while delivering profitability. I think that perspective needs to be kept in mind. Having said that, will we continue to be a thin margin industry? I think yes, it will be. Also, given the amount of competition that's coming in with newer entrants, both foreign players as well as private equity investors who are looking.
So how's the inquiries or response from foreign players after complete 100% opening up, and a lot of PE investors investing? Means they are willing to invest?
It's gone through the roofs in terms of the inquiry and the excitement around India and everyone wanting to understand the India story. with this kind of underpenetration, the kind of population that we have, it is of interest to every person. So we've got inquiries of three kinds. One is PE investors who are looking to enter largely general insurance industry. The second is the existing foreign insurers who are in India, who are thinking about how do we restructure so that we can get more operating control and play a larger role in the India story. And then there are a third type, which is foreign insurers who are not in India but looking to enter India, who are then looking for JV partners and how we can make this happen. So I think interest on all three fronts, a lot of new players that we will see in the industry.
From your report only, health insurance has emerged as a industry's biggest growth engine. Do you think that this will continue going ahead also? Health insurance.
I would think that health will continue to drive and be a large pool of growth. The question, however, is can it also become the profit pool? Because today it is the growth engine, but it is not the profit pool. You're not making money, especially if you de-average it and look at it on individual policies, which is the indemnity policies. We actually don't make money at all. It's a few insurers make single-digit ROE. Most other insurers actually lose money on that. It is the personal accident and travel, which when combined with the individual policies is how you come to, even like bare single-digit ROE. On that front, Anurag, I personally believe that what we need to move towards is more a connected care model. What's happening today is we buy an individual policy. Then we don't have any cover for OPD. We go and spend out of pocket. We go visit our doctors. For our wellness, which is, increasingly becoming top of mind for most Indians, we will go tie up with some gyms. We will go tie up with some, dietitians and other things to manage our health. None of this gets connected. And I will have one individual policy, maybe something as a group policy from my employer, and then I will have a couple of other maybe riders or covers. None of it kind of ever comes together to give the full picture. So until we move to a connected care model where we are actually taking care of someone's health.
Few insurers are working on it?
Yes. A lot of conversations around this is already happening. Few insurers are already providing this, but I don't think we've been able to stitch it completely end to end currently. I think when we are able to get there, not only will health insurance be the growth pool, but also hopefully turn, into a profit pool.
Now I'll move to our rapid fire, leadership rapid fire segment, and you have to answer my question spontaneously. Shall I start?
Yes, sure.
Okay. Growth or profitability, which matter more for the insurers over the next 5 years?
Disciplined growth.
One insurance segment that will create the next big opportunity in India?
Fire.
Are insurers winning on pricing or losing on underwriting discipline?
Underwriting discipline.
One reform that will have the biggest long-term impact on India's insurance industry?
The public digital infrastructure.
Will customer experience become more important than product pricing by 2030?
Indeed, it will.
One global insurance trend India should adopt immediately?
AI, not for the sake of AI, but AI for the sake of transformation, where we are genuinely taking use cases and transforming the entire function or the entire motion, not just, individual use cases.
If you had one day as IRDA chairperson, what's the first reform you would announce?
Two. Let me choose two. So one, which is the digital public infrastructure and a much larger push on creating the CIBIL equivalent for insurance. And the second would be awareness.
One insurance myth the industry still believes that need to change?
That mis-selling is the biggest concern in the industry.
If you had to remove one problem for insurance industry overnight, what would it be? You can pass also.
Yeah, pass.
Okay. Can India become one of the world's top 3 insurance market by 2047?
It will definitely be one of the top 3 markets by 2047. And hopefully we'll also have the highest value creating insurance from India.
If you were not advising insurers, which industry would you love to transform?
Healthcare.
Healthcare. So healthcare is part of insurance only. Okay. So final, what would be your insurance mantra for our viewers? And they will be policymakers also, insurance company CEOs also. So what would you suggest them, or what would be your mantra for our viewers?
Buying insurance should be boring. Using it should be brilliant. So boring and brilliant. I think that should be the mantra for insurers.
Okay, thank you so much, Pallavi, for joining Insurance Mantra and sharing your thoughts on our show. Thank you so much.
Thank you, Anurag.
So that's a wrap on this edition of Insurance Mantra, but we'll leave you with our Did You Know Insurance Basic. So did you know that IRDA has made it mandatory to tag an authorized salesperson with every insurance policy sold, whether it's through a bank assurance channel, whether it's through a distributor, through a web aggregator. So now every proposal policy and certificate will carry the name of authorized salesperson effective from 1st January 2027. This means every insurance policy can be traced to the person who has sold it, improving transparency, accountability, and customer protection. The move aims to reduce mis-selling and strengthen trust in insurance industry. So stay informed, stay protected. That's our insurance mantra.